The Morgan Report with David Morgan.
David Morgan of themorganreport.com for the week ending 24 June 2022. Well, I put some thought into what I wanted to do this week. I do that every week, but a little more than normal. And what I wanted to do is talk a bit about the word inflation or the definition of inflation. And I spent a lot of time looking at different things, and I actually thought this was the best way to do it. This is from one of the stalwarts in the Austrian school, Murray and Rothbard. And Murray is famous among the Austrians, as he should be. In fact, I digress, I was actually at a function in New York City that honored him, and it was quite a time. But getting on to the point, in this 1986 article, he talks about the Reagan miracle that, we can have an increase in the money supply, and yet the consumer price index remains flat. The cheap money's abundant, stocks and bonds are booming, and yet prices are stable. Sounds like a repeat right now up until very recently. And it goes on. I don't read the whole article, so I thought I would just highlight this part of it that I think says it all from an Austrian perspective and the way I look at it. Problem is not simply history. There are very good reasons why monetary inflation cannot bring endless prosperity. In the first place, even if there were no price inflation, monetary inflation is a bad proposition. For monetary inflation is counterfeiting, plain and simple. As in counterfeiting, the creation of new money diverts resources from producers who have gotten their money honestly to early recipients of the new money, to the counterfeiters, and to those on whom they spend their money. I'll leave it there. A lot of people are talking about, food and energy costs, and I could argue that's a result of the monetary inflation. I could also argue that it is due to shortages and crop failures and infestation by locusts and storage facilities going away, and all of that plays into it. So I want to just come back and focus that even if there were no price inflation, we're counterfeiting. And these things end badly. And I know anyone that follows my work probably knows that. I don't want to overemphasize or underemphasize the fact that we are in a new paradigm. I said on several interviews going back 6 months to a year and a half, that once the food/energy, quote unquote, inflation started, the general public would not worry about, was it from monetary inflation? Was it from cost push inflation? Was it price inflation purely? They don't care. All they care about is what it costs them to feed themselves and to travel in a mechanical conveyance of an automobile or a truck or something similar. So the idea is it's very much a psychological phenomenon as well as a monetary result. And I think people can overlook that. My take at this point in time is that the inflationary mindset is probably only another month or two away from being in the public consciousness on pretty much a worldwide basis, where most of the average normal people are determining that the money that they have, be it whatever currency, is going to be worth less in the future, at least for food and energy, and they better spend it now. There are arguments why there could be deflation, and I've made those. I'm not going to do that here, but I thought just as a reminder to myself and everybody else, kind of trying to keep it simple and sincere, what Murray Rothbard had to say about inflation. Now I'd like to take a quick look at the gold price performance. This is from goldprice.org, and how gold is responding in different currencies. So you can see the years listed here and the performance on a percentage basis across the board. So if you look at this for this year, 2022, the Aussie dollar, Canadian dollar, Swiss franc, Chinese yuan. What's interesting is over here, the Japanese, it's up almost 17% so far, and Japan's probably the worst as far as the amount of paper they print on a monthly basis. The British pound up about 10%. So the idea that it's only dollars that we worry about, and North America pretty much do, and the world looks at the dollar as reserve currency. We know all that. But on an average basis, you can see that the U.S. actually isn't the lowest. It's in yuan, which is interesting because the Chinese pretty much peg their currency to the U.S. dollar. We've gotten 6% on the Swiss franc. I missed that. That's actually the best performing or best performing currency relative to gold. But even the Swiss have caught the inflation disease. And as you can see in certain years, like 2009, gold was up 20%. So the idea is gold is doing its job. It's holding or maintaining your wealth. I put up something on my Twitter about a week ago showing that gold was basically this number, 0, for 2022, but how far down the bond market was, the S&P 500, the real estate market. So it's a poor comparison, but it's an accurate one. Gold lost nothing, while all these other main classes, bonds, stocks, and real estate, lost rather substantially. I do believe gold will go higher. It's probably not going to be imminent, but we don't know. And silver's price performance, you can see a lot more red in here. Same chart, just silver, same currencies across the top, same average across the bottom. And you can see, silver hasn't done horribly over this period from 2007 to 2022, about 7%. And this is something that I thought about today. When I was a teenager, I could buy a gallon of gas for 25 cents a gallon. And if I take and right now a junk bag of silver, $1,000 worth of quarters or 4,000 quarters will cost you 25,000 in fiat. And so that's a 25-fold increase. If you take 25 cents and you multiply it by 25, it comes out to be $6.25, which means you can still buy a gallon of fuel for a silver quarter. I know silver's been disappointing. Actually, both have, but primarily silver over the last decade. But it performed well for the previous decade. And I do think we're in a lull. We're going to get better. And it probably won't be for a while. But now is not the time to give up the ship, especially going back to what I said a moment ago. You see that gold is maintaining in U.S. terms and actually increasing in almost every other currency. So I thought I'd spend a little time on the commitment of traders. I don't do this in the public domain much. I do it in the premium service from time to time. So what we really want to focus on here is the commercials. The commercials are purportedly the producers, like your Pan American Silver, First Majestic, your conglomerates like BHP or Rio Tinto. So they're supposedly the producers. Now, this is true commercial on most of the other commodities like the ags, like wheat or corn or any of the ags. However, in the silver category, it's kind of a misnomer because this is primarily the bullion banks. And I say primarily because somebody like RTZ or BHP that looks at silver as just a bookkeeping entry, it's something they use as a credit in the way they keep score in fiat, really don't care about the price of silver that much. And in some instances, they'll give their book or what they produce to the commercial banks, to the commercials, which are the bullion banks primarily, to manage that part of their balance sheet. So what I want to point out is commercials are still pretty strongly net short. You've got 82,000 contracts short and 60,000 long. We can do that math in our head. 82 minus 60 is 22,000 contracts net short from the commercials. Now, the main players against them are the trading funds. You could throw hedge funds in there. Trading funds are pooled accounts that manage your money. You don't know how to trade futures. You send your money into XYZ trading, and they spread out amongst all kinds of commodities. They got some money in the oil sector. They got some in the ags. They got some in metals, and on it goes. These are the guys that get wiped out all the time. And they are pretty strongly long right now. You've got 57,000 long, 43,000, which is 14,000 net long, against 22,000 net short. And what's the rest? The rest is the public. It's right here. It's called non-reportable. And if you do the math, you'll see the public is always long, just like the banks are almost always short. So you do the math there, it's 4 and 4, 8. So the numbers add up. 8, 14 equals 22. So there it is. I am not looking at this as favorable or unfavorable right now. The commercials have not, what I consider, bottomed out. The open interest is still pretty high at 152,000, I'll call it, rounding up slightly. So I would just sit and wait right now. The idea being that when in doubt, stay out. I think it's a good time to accumulate. I think if you're willing to, dollar cost average in or nibble at the market, I do think there's a fairly good possibility of seeing a spike low. As I've said in the past, I wrote an article for Futures Magazine, one time only. It was called Spiked, and it went through my trading and what the metals do. And they usually spike high and they usually spike low. And we could see that if that were to occur, that would be the time, I believe, to go ahead and get long fairly strongly. I'm not talking futures. Most people should stay away from them. But as far as those that are in the equity side or whatever, I finished an interview with the Money Show this week and talked about getting a return on gold and silver through the equity side, which is a very conservative strategy known as covered call writing. I went through the very basics of that and pointed out that I do that. Look over my shoulder feature for our premium members. The only question I had time for, a gentleman asked, well, I don't want to do all this option stuff, even if it is conservative, even if I win 85% of the time, even if you can make 18, 20% a year. I just want a dividend paying stock. Well, they do. There are precious metal shares that pay dividends. And what I pointed out during this Money Show lecture was that when I bought Pan American, it was around 250 and the yield on it was like 1%. But now that it's 25, and I've looked at the price, you can check me, but basically I'm getting about a 10% yield relative to where I purchased it, but I've owned it for almost 20 years. But that shows you what investing is. Now, you can't do that in the silver market. You can write options, or you could lease it. But as far as the equity side, it does play a part. It does play a role. And there aren't many investments you can make in the precious metals other than the physical side that will continue to give back. So the amount of price appreciation in that equity is superior or close to the same as what silver's done in the last 20 years. But it's also paid a dividend, and you can also write options against your position. Couple more articles quickly. This is from Yahoo Finance. As you can see, silver price forecast, silver market stages of recovery. You can read this. I think the important takeaway here is this. Breaking through the $21 level to the downside opens up a move to the 2050 level, possibly even the 20 level. Breaking through the 20 level would be extraordinary negative for silver, opening up the $18 level as a target. My premium members know, and I've said it in the public a few times, been asked how bad could it get, and I said 18. That's as bad as it'll get. Is that the exact number? What if it hits 1782? Well, that's close enough to 18 in my book, and it may stop at, I don't know, 1828 or whatever. Point being that that's the level to watch. As I just said a moment ago, silver and gold, but especially silver, has a propensity to spike low, spike high. So I would really believe that if it were to break the $20 level, you would see that commitment of traders change. You would see the shorts, the commercial banks, the commercials, the bullion banks cover like mad. And if they can, to the best of their ability, and you see that stay at that low level for a very short period of time, meaning maybe one day, maybe 1 week, but I doubt it'd be longer than that. So prepare yourself for that possibility. In the meantime, anything around the $20 level on a longer term basis for silver is a good buy. Anything under 2,000 for gold is a good buy. And we'll talk about gold for a minute. This is from Reuters, 24th of June. And talks about gold being little changed. Gold prices are vulnerable. Gold looks vulnerable over the near term, given its inability to break 1850, its 200-day moving average this week. This Simpson said, "We are not in fear of a global recession. If we were not in fear of a global recession, then gold would likely be lower than it already is." Of course, this is Reuters. Nonetheless, both metals, as I said a moment ago, look like they're going sideways to lower in the short term to me. And the commitment of traders is not highly favorable either way. But we all know that gold is doing its job, and silver, as poorly as it has acted as far as people's expectations, 25 cents in silver still buys a gallon of diesel. All right, now I just want to focus a little bit on the crypto world. As most of you that follow our work know, I've done a lot in the crypto conspiracy series. I think we have 23 or 24 different videos on the topic, but here's one that I've actually alluded to way back in, I think, 2014, when I wrote my 2 bits about Bitcoin. In that I said that to watch out if it catches favor, the regulators, the powers that be, the money powers will not be happy, and they will make adjustments. So the BIS, the Bank of International Settlements, the Bankers Bank, crypto structural flaws make it unsuitable as a basis for a monetary system. Well, about as suitable as the fiat system we have now, but they may be better in some respects. But let's just leave it at the headline as it says. I think the subheadline is even more important. But central banks are very keen to develop and control their own cryptocurrencies. My, what a prediction. So I won't read the whole article. I think you got it just basically from the headlines. I did go over this on my Twitter feed as well. The report points out to the fragmentation of the sector, which is defined as the abundance of different cryptocurrencies competing for supremacy, as perhaps crypto's greatest flaw as the basis for a monetary system. So in other words, you get a choice, it's the central bank's choice, and none other. That doesn't mean these cryptos are going away. A lot of them are. A lot of these coins that are basically called S ... are basically that, and they will dry up and blow away and never be heard from again. But just like in the tech wreck, there will be some that will come through and will, I guess you could say, compete with the central bank digital currencies. As I've said earlier, if you follow my work closely, I've said this months ago, that I thought the final shakeout would be CBDCs, track and trace, cashless society, or very close to a cashless society. And the remaining cryptos can be used, but not in a quote-unquote official sense, where I outlined that it could be used for purchases on private goods. You could buy a car or sell or even a piece of real estate, but you couldn't get a mortgage with Bitcoin, although I think you can do that now. But the point being is that any major thing like a utility bill, a phone bill, primary mortgage to a normal bank, car loan, anything in the credit system that's official would probably be determined by a central bank digital currency, not an alternative, even though the alternative you could pay in, say, Ether or Bitcoin or whatever. So that's where I see it at this point in time. I will leave it there and close out another weekly perspective. This is David Morgan of themorganreport.com.